Welcome to another episode of VA Wednesday. So today we're going to talk about community property states and how this affects you as a VA loan borrower, okay? So first of all, there are only 9 community property states in the country. So if you guys are in one of these states, pay attention to this video. They are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin, okay? Is that 9? 1, 2, 3, 4, 5, 6, that's 9, okay? We did it. So here's the deal. So basically, if you're getting a VA loan, and let's say your spouse, like, oh my God, they are just in terrible debt, and they have a terrible credit score, and they are a hot mess, okay? And you're like, well, I'll just be on the loan, like, I look good, and like, I don't need their income, so just don't put them on the loan. Yeah, about that. So we don't have to have them on the loan. However, if you are in a community property state and you are getting a government loan, VA, FHA, USDA, we have to run your spouse's credit and hit you with their debt. Yes. So even though they're not on the loan, even though we're not using their income, and you're probably like, well, Jen, can I use their income then? No, no. We take all the icky stuff, but none of the good stuff if they're not on the loan. So we run their credit, we put their debt against you. Yeah, that's the rule. So if you're in a community property state, it means that the courts look at the debt that you guys accrue while you're married, even if it's not you. Like, I have so many cases where it's like, oh my God, my husband, like, I cannot get him to stop opening up credit cards. Same way around. My wife is the worst. Every time I look, she's like not paying a bill. And so people, especially like the newer generation, they have very separate finances. Well, if you're getting a VA loan and you're in one of those community property states, what your spouse does affect you. Okay? Now, in terms of score, just because their score's low, does that mean you won't get a loan? No, but we do hit you with their debt. So if they have a ton of monthly debt, 2 cars, another house, credit cards, student loans, all that debt is going to be used against you in a community property state. Now, one thing that happens a lot, and even experienced lenders, it happened on my team yesterday. A lot of lenders, if they're California, Texas, if they're in one of these community states, they're used to running the spouse's credit on all VA loans because they're used to California or Texas or whatever else. And it's very important that if you're in a non-community state, if the lender's saying, hey, I need to run your spouse's credit, you say, oh, we're not in a community property state. You don't need to do that. And if they push on you, okay, they're wrong. They're wrong. And if it's an assistant pushing on you, I would talk to the loan officer. I have someone on my team who's brilliant, amazing. She's the best. But once in a while on the community property, she just reverts to California and Texas because we do so much there. So it's important for you guys to know that if you are not in one of these 9 states, we do not need to run your spouse's credit. We do not need to hit you with their debt if they are not on the loan. Okay. And I see a lot of people, they come to us and they're like, oh, well, I don't qualify because my husband. And I'm like, you're not in a community property state. Right? And so you want to make sure your lender's on top of that. And it's good to know if you're in a community property state. Like just from a financial perspective, I know I live in California. If my husband went on a spending spree, it's half my debt. So you want to be aware of this. You want to make sure your partner knows this because your finances are considered combined. Yeah, I don't know. Okay, one more important note. Now, if for instance, let's say that your spouse, before you got married, okay, let's say you got married last month and they just had this horrible, all this debt, but it was pre-marriage. Sometimes we can exclude that because it's not really your debt if they took it out before marriage. Generally, that's going to be like cars, houses. It's really tough to do it with credit cards because usually credit cards, is something they're using monthly. So it's hard to prove how much was before marriage and how much was after. But it is important to know because if you're watching this and you're like, oh, I'm not going to marry them. If it's pre-marital debt, it doesn't necessarily count. So you want to make sure you have that conversation with your lender as well if you are in one of these 9 community property states. Thanks for watching, and I'll see you guys next week or tomorrow. I mean, if you want to hear about other loans, I am 50% conventional, 50% VA. Thanks for watching.